Okay, so welcome to Chapter 6. In Chapter 6, we're going to be discussing all the concepts of cost behavior and how we can use the concepts of cost behavior to make decisions and predictions about the future. Okay, so in Objective 1, we're going to talk about the key characteristics of cost behavior, and we're also going to look at some of the graphs on how some of these models look like. So the most common cost behaviors are, again, getting into the basic definition of cost behavior is, again, how costs change as volume changes. Again, how cost changes as volume changes. And it's just important to know as a manager because it helps you to predict. You always want to try to predict and plan for the future, and that's why it's important to know how costs behave. Now, in one of the next slides, we're going to deal with the variable cost. That's usually the one managers hate. We'll get into all that. We also have a fixed cost. I'm going to talk about that right now in a moment. And then we've got mixed cost, which is basically both variable and fixed. Now, regarding your fixed cost, before we get to variable, there's two ways to really look at a fixed cost. You have what's called a total fixed cost, and you also have what is a per unit fixed cost. A total fixed cost is a cost that, as it relates to volume changes, it's constant. This is basically like your rent. Okay, rent is fixed within 6 months. On a per unit view of a fixed cost, it actually varies, and it varies, I'm going to write this, inversely with activity. And that idea is basically, think about, if you're renting a production facility or leasing a facility, it doesn't really matter how many units you produce, your fixed cost is going to be staying the same. So what happens then is as volume goes up, the per unit actually goes down, and that's what businesses like. They like to see that per unit cost go down. But from a pure definition standpoint, the total fixed cost does not change, but the per unit does. And that's why companies often like to max out production, because if they can get volume up, they can get their per unit fixed cost to actually go down. Okay, so we'll start with variable cost, and I like to always tell my classes, look, variable costs really behave in two different ways. So you want to kind of highlight this. First of all, you have what's called a total variable cost, and you also have a variable cost per unit. So a total variable cost is a cost that, note, it changes in direct proportion to changes in volume. Okay, so a total variable cost is a cost that changes in direct proportion to changes in volume. So in other words, it could be, let's just use an easy one, direct labor hours. So if you have wage earners, if they work more direct labor hours, that's your volume, you're going to have to pay them more money. Okay, so you can make a note. Direct labor hours would be a good example of total variable cost. In terms of a cost per unit, notice the rule says is they remain constant. So in other words, they are fixed. Okay, and likewise using this, if you work, let's say, a minimum of 0 to 40 hours, you're paid $15 per hour. So that rate, that labor rate that's basically within this range of activity is fixed. Okay, now once you go beyond 40 hours, obviously, overtime and stuff like that can kick in, but you're just using a basic model of, and we'll get to the concept of relevant range a little bit later. Cost per unit for variable actually is fixed. It does not change within some sort of certain relevant time period. Now, later on, we're going to look at a couple graphs. Just kind of make a note that the slope of those graphs is essentially your variable cost. And just some basic knowledge about graphs. Obviously, you've got the vertical, or the y-axis, always shows the total cost. So notice you're always going to have total costs listed out here on the y. The x, which is always your horizontal, is always going to represent volume. And as you're looking at these two examples, notice you've got volume here on your x, horizontal, number of guests, and you got the total cost. This was toiletry variable cost, and you'll notice that in this case, this line right here, you see the red line, that's going to represent the slope, And of course, this one is breakfast and refreshment hour variable cost, which is $10 per guest. And notice again, you've got volume here on the X, and you've got your total cost here on the Y. And then again, note off here to the side, very important, variable cost per customer, that notice that's also per unit, remains constant in each of the graphs. Okay, so coming up on the next objective, we're going to get into what is called cost equations. And again, cost equations to express, and I mentioned this earlier, and to predict cost. So again, we're going to spend a lot of time talking about variable cost and how we can use that to make predictions. We're going to look at fixed cost, and we're also going to look at the mixed cost, and we'll look at some methods on how we can take that mixed cost and actually split it between variable and fixed. Okay, so looking at a cost equation to basically predict your variable cost, basically it's right here, and you can look at your variable cost as basically your variable cost per unit, okay, multiplied by your activity, which of course we're going to label activity as letter X, and that's going to give you a prediction of how you can figure out your total variable cost. And keep in mind, some of the assumptions we're using is that we believe that the variable cost is linear and that it will fall on a straight line, and that therefore is going to allow us to make these predictions. So again, reviewing some of the key characteristics of a variable cost aspect. Again, total variable cost, change. Again, I'll note this, the total, that's the first way to look at it. Total variable cost change in direct proportion to changes in activity. Again, this is what managers and companies do not like because this is a cost that you're trying to reduce cost, you're trying to increase volume of production, but you got these tag-along total variable costs that just destroy your income statement. The second way to look at a variable cost is a per unit basis, and notice I mentioned earlier it's constant, and it's basically going to be the slope, okay? And of course, the rest of it just kind of talks in terms of if you're going to do some graphing. Remember, I'm not really going to have you do graphs on exams. I'm not going to test you on graphs, but just to kind of bring out some of the visuals, they like to kind of give you these little labels. And you don't really have to follow those. I do not test on these, but if it helps you to understand the concept, that's great. But just remember, your total variable cost equals basically your variable cost per unit multiplied by the volume, which is basically expressed right there. Now, I mentioned this earlier. Again, you've got the key characteristics of your fixed cost, and we'll look at this in two different ways. Number one, total fixed costs are constant. They don't change over some sort of relevant volume. And then the second way to look at it is from a per unit standpoint, and notice it varies inversely with changes in volume. So in other words, if volume goes up, your fixed cost per unit will basically go down, and vice versa. If volume goes down, your fixed cost per unit actually goes up. So again, there's that inverse relationship. And of course, the rest of this is just kind of getting into the graph aspect of it. Later on, when we get into looking at mixed cost, I'll use my own symbols and show you probably a more simple approach to follow it. But right now, to me, the two big things is to know the two big characteristics of fixed cost, which I've labeled here as number one and number two. Now, if you look at this particular graph, notice your fixed cost. If it's 100,000, your fixed cost is always going to be flat. It's always going to be basically the flat line. Okay, notice as your volume changes up or down, notice it's your fixed costs are flat. They do not change. So this is basically constant in total, and that's the key characteristic of a fixed cost attribute. Okay, so we're looking at a mixed cost. Remember, a mixed cost is going to have, I like to just say both. It's going to have both variable and fixed in there. And so the basic idea is you've got, again, total cost. You have some aspects of variable and some aspects of fixed. And to want to make decisions and predictions about the future, you want to basically be able to try to separate out what part of it is fixed and what part of it is mixed. Now the first part here kind of talks about the graphing, but if you kind of get down here, when they get into this equation, you got whether y equals vx plus f, and again they're coming up with some of these symbols, and I'm not again going to test you on these symbols, But again, you've got a total cost, which typically I will represent, that's what I'm going to call Y. You've got your variable cost, you've got your volume, and you've got your fixed costs. So what I tend to like to write out is I use something like this: Y equals A plus BX, where I like the letter A to represent my fixed cost. I like the letter B to represent my variable cost per unit. Notice I use X for the volume just like they do. And this is basically the format I like to use. Now I know you've all taken a math class. Sometimes they might label it as MX plus B or whatever, but I am kind of stuck in my little symbol, so I like to use Y equals A plus BX. It's the same, essentially the same as this, except I label your fixed cost as letter A, your variable cost per unit as letter B, which is really your slope, and then X is going to be your volume. And again, you can look at this graph, and of course you can see here could be a model of a mixed cost, and you notice you've got some fixed cost right here. You've got, again, the costs going up like that, so you know that it's basically as volume goes up, your costs are starting to increase, just like a variable cost would. But again, you know, in this case, they're telling you it's $8,000 per month fixed and $8 per unit variable per unit. You could get some problems where they don't tell you this information, and you might actually have to try to figure this whole thing out by using some different types of methods, which we'll get into a little bit later. Okay, now just to show you a couple examples again from your textbook. This is exercise S 6-1. And it says the following chart shows 3 different costs: cost A, B, and C. It says for each of these costs, the chart shows the total cost and cost per unit at 2 different volumes within the same relevant range. Based on this information, we want to try to figure out, are the costs fixed, are they variable, or mixed? So let's first look at the volume. Notice you've got 4,000 and 5,000 units. We've got cost A, B, and C. We'll start with cost A. And note, look at the total. We've got a total of 42,000 at 4,000 units and a total of 50,000 at 5,000 units. The first thing I like to look at is cost per unit. And you can clearly see by taking 42,000, you divide by 4, you get $10.50 per unit. At 5,000 units, you take 50,000 divided by 5,000, you get $10 per unit. Now, if we looked at the total cost, we know it's not a fixed cost because the total cost did change. So it's that the total cost is not constant. So we know it's not fixed. The next aspect to look at this is the cost per unit. And as notice, it was $10.50 and then it went to 10. Now, because this didn't stay the same, the cost per unit, there's no way it could be purely variable. So your first one has to be a mixed cost. It's going to have some fixed and some variable in there. On cost B, let's take a look at it. Notice you've got 60,000 total here and 60,000 total there, both volumes. To me, that's looking a lot like a fixed cost because the total is constant. And then if you look at the per unit, you're at 15 and then 12. Notice that the per unit went down as volume went up. So cost B, you would say that's purely a definition of a fixed cost. Now, the last one, notice you've got 32,000 versus 40. So it looks like costs are going up. So it could be variable, but you have to look at the per unit. If it stays the same, then it is going to be variable. And notice they're both at $8. So the very last one has to be a variable cost. And again, I already explained these are the correct answers, but I explained it in the previous slide. Cost A again is mixed, cost B is fixed, and cost C is variable. Now you notice earlier I said relevant range, and let's make sure you understand relevant range is really what makes all of those relationships valid. So when we talked about total fixed costs remaining constant at a relevant range, that could be for 6 months. For example, rent. Rent is fixed for the 6 months. So for the next 6 months of activity, that's your relevant range. Variable cost per unit remain constant at a certain level. That certain level is within the relevant range. That could be labor hours working 0 to 40 hours. Your labor rate per hour per unit stays the same. It's constant. So that could be an example of the relevant range, which is 0 to 40 hours. and of course the per unit, which would be direct labor cost per hour, would be constant. Okay, so now turn to exercise 6-21A. This is the Princeton dry cleaners, as they have the capacity to clean up to 5,000 garments per month. The requirements of this problem, you've got three of them. Number one, they want you to complete the schedule, which we'll get back to in a moment. Part two, they want to come up with the average cost per garment. And then part three, we're going to come up with some reasoning on why you may not want to use average cost to make predictions. So the first thing I see up here, notice the volumes. You got 2,000, you've got 3,500, and you've got 5,000. They've given you the total variable cost at 3,500 and the fixed cost per garment at 3,500 as well. So the way we're going to fill in these pieces, let's start with the 3,500. So if we've got total variable cost, what you want to do is you want to take that $2,100 and you want to divide that by 3,500. Because what you're going to get there is when you take 2,100, divide that by 3,500, that's going to give you a variable cost per unit. So again, take your calculator out. Again, you'll take, I'm going to put this up here so you can kind of see this. So again, you take the 2,100, divide by 3,500, and you're going to get right at 60 cents. Okay, that's per unit. So once you've gotten that, I'm going to erase that now. So that's going to give you right at 60 cents, 0.60. That's your variable cost per unit. Now, when we've got the fixed cost per garment at 2, we can go ahead and take 2 and multiply that by 3,500. So 2 times 3,500 is going to give us the total fixed cost. And of course, we know that's going to be $7,000. So if we add these two together, we get $9,100. And then at that point, we can figure out everything else. You've got variable cost plus fixed cost per garment. Your total cost there is going to be $2.60. Now, if you use these rules of cost behavior, let's start with total fixed cost. Notice total fixed costs are constant, right? Which basically means at whatever level of volume you're at, it's going to be fixed. It's going to be the same. So 7,000 is going to go there, and 7,000 is going to go there. This total is fixed. Now, regarding your variable cost per unit, it's also fixed. So we know that at 5,000 it's going to be 60 cents, and at 2,000 it's also going to be 60 cents. And notice how now you can just kind of copy those over. The rest of it is just basically you doing some dividing and doing some adding. So if you want to get the total variable for any of these, all you have to do is multiply the variable cost per unit times the volume. So 60 cents multiplied by 2,000 is going to give you what? That's going to give you $1,200. You take 60 cents times 5,000, that's going to give you 3,000. So now we've got the totals. You can add those down. And then of course, to get the per units here for fixed, you would just take these individually, take the 7,000 and you're going to divide by 5,000, and also take the 7,000 and divide that by 2,000. You'll get the fixed cost per unit there. You can then add it all up, and then that's going to give you your averages. I'll show you the rest on the next slide. So again, you'll notice, like I said earlier, you started with these till you knew the 2,100 and you knew the $2. And I'm sorry, you started with, yeah. And so in that case, what you did was we figured out the variable cost per garment. In this case, we figured out it was 60 cents there. Notice how that's the same for all of them. Also notice when we took that $2 fixed and multiplied that by the 3,500, that gave us the 7,000. Notice that's also constant as well. So 7,000, 7,000, 7,000, that's a total fixed cost. Notice the variable costs per unit are also fixed, 60 cents, 60 cents, and 60 cents. And then if you kind of refer back to the previous slide, we also figured out that once we knew the variable cost per garment, we can multiply that by 2,000, we got 1,200. So your total cost there are 8,200. For the 3,500 volume, we knew it was 9,100. And then at 5,000, we knew it was $10,000. Now, the last step would be to get the fixed cost per unit. Notice how the fixed cost per unit actually go down. So, for example, when you take the $7,000 and divide that by 2,000 units, that's going to give you this basically, here's your 350. When you take the $7,000, and of course we already knew this, and divide that by 3,500, that gives you the 2. And then when you took the 7,000 and divide that by 5, that's going to give you the $1.40. So what happens is that your fixed cost per garment, notice how as volume increases, your fixed cost per unit actually goes down. And so at 5,000 units, you're only paying about $1.40 per garment fixed cost because of that increase in volume. Now, when we get to the last part of this problem, when they talked about using at full capacity, your average cost to make it $2, factoring in variable and fixed, you cannot use this to predict cost for a lower volume because of that fixed cost aspect of it, because you're going to be grossly underestimated, because this chart is showing you your average cost to make is really $4.10 at this volume versus $2 at the higher volume. So volume does matter in terms of being able to predict cost. And of course, I just explained this again, the average cost per garment is changing because you have fixed and variable components in there. And the big thing, go back and review it, the fixed cost per unit decreased while the variable cost per unit did not change, it remained constant. So again, if you use 2,000 garments as your production, this $2, remember that's at the 5,000 volume capacity. If you use that times 2,000 garments, your predicted cost would be 4,000 versus actual cost would be about 8,200. You're going to be grossly underestimated if you don't understand cost behavior. Okay, in the next objective, we're going to look at different ways how you can use these rules of cost behavior and use what's called account analysis and scatter plots on how to use cost behavior, again, to make decisions and to predict the future. Okay, so there's basically 4 types of different methods that you can use to analyze cost behavior. We'll talk about each of these. You have account analysis, scatter plots, high-low method. We will do a lot of that. We'll do just a little bit of regression because statistics is not a prereq for this course. We'll at least show you a little bit how you can regress a couple of variables to see how well they fit on that line. And regarding scatter plots, again, I'm not going to have you graph anything, but I think it's important just to take a look at, just to give you some visuals on how this stuff works. So account analysis is obviously a little bit more subjective. It's basically you look at ledger accounts, you classify accounts as variable, fixed, or mixed. And of course, notice it says using judgment. So you have to know something about the business to be able to do this to begin with. It's very subjective, but that's the first one. They call it account analysis. Scatter plots is basically a little more graphical, more statistical, where you have the X and Y data, and you're plotting these, and you're basically trying to see how well these fit on a line. I'll kind of draw you a little picture of a scatter plot right here. You would have all your variables, and you're looking for patterns, you're looking for relationships, and again, you're seeing if these do fit a pattern. And quite honestly, you're trying to see, is there some sort of linear pattern? If there is, then you can maybe make some predictions using X and Y data. And of course, here's a better picture than the one that I just drew. And you can see if you look at this scatter plot right here, if you had to guess, if you had to draw a line through all the dots, where would that line be? To me, this looks a lot like it would be an upward line. They don't all fall in the line, but it looks like there is a linear relationship here. So we'll get into regression and high-low method coming up, but this might be a good way to be able to understand the visuals, how you might be able to use some more methods to make some predictions about your volume versus your utility cost. Now, first one we'll look at is the high-low method. This is the easiest one. This is thinking that there is a linear relationship, and it's just basically about plugging numbers into your equation and trying to figure out what part of your mixed cost is fixed and what part is variable. But again, you're going to use this method to separate out, I'm going to write this here, separate your mixed cost into fixed and variable. That's basically what we're doing. If we can do that, it's going to help us to predict future cost. Now, the first few steps are pretty simple. The first one says we want to figure out a variable cost per unit. The next step is then to find the fixed cost, and then the final one is to create the cost equation, which we'll walk you through in a moment. Advantage is this is very easy to do. You'll find out that probably you'll learn it within 5 minutes. You won't forget it. The bad thing about this method is you're only looking at 2 data points. You're only going to look at the high and the low. So your data can be thrown off by extreme data points, or what they call outliers or anomalies. So if your high is too high or your low is too low, that could affect your predictions. Okay, so we're going to be looking at exercise 6-27A in your textbook. And the problem says use the high-low method to determine Flower Power's cost equation for van operating cost. Use your results to predict their operating cost for 16,000 miles. So again, this is going to be an example of we're trying to get some mixed costs to separate those out into variable and fixed. So here's what they give us. It says Kara Wu, owner of Flower Power, operates a local chain of flower shops. Each shop has its own delivery van. Instead of charging a flat delivery fee, they want to set the delivery fee based on distance driven. They want to separate the fixed and variable portions so that they can have a better idea how delivery distance affects these costs. Here's the following data. You've got miles driven, you've got operating cost. So miles driven is going to be, I'm going to label this, that's going to be your activity. Van operating cost, this is going to be your total cost. I like to use the equation y equals a plus bx, where again y is going to represent your total cost, a is going to represent your fixed cost total, b is your variable cost per unit, x is your activity. Notice they've already given you the activities. So when you set these up, and in the next few slides we're going to walk you through the answer, what I tend to do in class is I always tell my students, here's what you need to do. Draw high, draw low. So I would make a couple graphs on the board. I would then have activity, and then I'd have the dollars. And all you do is you look for the high activity. And in this case, to me, it looks like the high activity is 17,005. I would write that there. And the dollar amount that goes with that is 5,700. The low point, when I'm looking at this, to me, the low point looks like it's right at 14,500. So I'd write that right there. And the dollar amount that goes with that is 4,920. So what I have my students do is once they write it in this format, the next step is literally just to take the differences. So once you subtract, you're going to basically take the difference between the high and the low for activity, the high and the low for the dollars. That's essentially what you're doing. So when you do that, what you're basically creating is a range. So when I take the 5,700 and I subtract the 4,920, that's going to give me right at 780. So I'm going to write 780 right here. And then of course 14,500 minus 17,500 gives me 3,000. Okay, so then once you've done that, you've taken the difference. The last step is to take the change in dollars, which is 780, and you're going to divide that over that range of 3,000 units. So again, I'll say this again because students often get this wrong. You always take the dollar amount divided by the change in activity, and in this case it looks like you're going to get right at about 26 cents. So once you've done that, I'm going to write this right here. That 26 cents, that's going to be your variable cost per unit. That's going to be constant over all this basically range of activity. That's not going to change. Once you figure that part out, I typically call that my step one. I've got that. So then what I do is I go back to this equation and I just substitute. And basically I always tell my students to pick the high point. The high point is 17,500, which is $5,700. So I'd have $5,700 substituted in for Y. A is your total fixed cost, which is what you're trying to solve for, plus your variable cost per unit, which is 26 cents. Multiply that by your volume again, which is 17,500. So once I've done the variable cost per unit, I'm plugging that in for B. X is your 17,500. I'm going to multiply that out. And then at the very end, you just have to combine like units. You're going to solve for your fixed cost. You can do that. Once you've done that, you just use the high-low method, and then you're ready to set up your equation to make predictions. Okay, so let's go back to our equation. Y equals A plus BX. So just so we have a little more room here. So we knew that our total cost were 5,700 plus equals A plus your 26 cents, multiply that by your volume. So once we combine all these like units, you're going to figure out that your fixed costs are going to be right at 1,150. Okay, so then once you know that, again, we already said that our variable costs per unit are at 26 cents. We can now combine these into our equation. This is our cost equation to say our total mixed cost would equal your total fixed cost, which is 1150, plus your variable cost per unit multiplied by X. Now, all these numbers are basically only valid within that relevant range, which is 3,000 units, because if you go back, the high point we said was 17,500, and the low point I believe was 14,500. If you go back and look at the previous slide, that's a range of 3,000 miles. That's your relevant range. So if they want you to predict, if you had driven, for example, 16,000 miles, could you predict your total cost? Well, you would plug in 16,000 for X. 16,000 is within the range, notice. And then basically, if you plug 16,000 in for X, multiply that by 26 cents, and then add your fixed cost of 1150, that's going to give you a prediction of right around $5,310. Okay, and that's basically the high-low method. Okay, so in the next objective, I'm just going to briefly talk about regression analysis and how you can use that to also analyze cost behavior. So if you've never seen an Excel spreadsheet, and again, this is not a stats course, so I'm not going to make this as a requirement, but lots of times in stats they have what is called the R-squared value. R-squared, in this case, this particular example they've given you is 0.94726. But what this all comes down to, let's go back to our linear equation, which I'd mentioned earlier. The basic assumption here is you're thinking that if you can get your scatter plot to line up into a linear format, and then going, all this is basically this is all stuff done by the computer, guys. If you see standard error, t-stat, p-value, don't even worry about that. I'm not going to test you on any of this stuff. But the basic idea of regression is that you look at all variables. You don't just look at the high and the low point, so it's a little bit better to the high-low method. But at the end of the day, this kind of mentions the R-squared value is what you're looking for. That's the predictability value. If you get a high R-squared value when you plug in all these numbers into an accounting spreadsheet, what that is telling you is how much of X can be used to predict Y. And if you get a number like 0.94, that's basically saying that one variable, okay, which is X, can be used to predict Y, which is your dependent variable. That's a good prediction. You're basically saying all these costs are driven 94% by that one variable. Okay, but everything else, again, I'm just briefly mentioning this because most of you will take a stats course where you will learn about what all these things mean. We could spend a few weeks just doing this part of this problem, but regression looks at the big picture. It looks at every variable. It doesn't just look at the high-low. And at the end of the day, you want to see how well do your variables predict, how well does X predict Y. Typically you want to get this number into the 90s, 0.9 or above. That's a good thing because that's all for predictive value. A good high R-squared value tells you that you can make good predictions of your cost. Okay, so next up we're going to talk about what's called a variable costing income statement and show you what is meant by contribution margin. Now, before we get into that, maybe a term you haven't heard of before is called absorption costing. And again, you would have done this in financial accounting. They didn't call it this, but this is what it is because now we're talking about cost behavior. Absorption costing is basically a GAAP type of income statement. Okay, it's for external reporting. And the way they came up with this absorption is that all of your manufacturing costs, all of your product costs are going to be absorbed into cost of goods sold. eventually. All right. So that's kind of where they came up with the absorption. Absorb. What are they coming up with this? All of your basic 3 product costs. Here they are. Product cost number 1, direct material. Product cost number 2, direct labor. And then they separated out overhead. But basically, that's your 3rd product cost. All of those costs are going to be absorbed and expensed when you sell them. Now, where that's going to differ from the variable costing, because it's always absorption versus variable costing type of income statement, is you're going to see that variable costing separates out your cost by cost behavior, whereas absorption separates out your cost by basically product versus period, basic idea, which is GAAP. Okay, variable costing doesn't look at it like that. It doesn't really care. Variable costing only looks at fixed and variable costs and separates it out that way. So down here below, they've given you a couple examples. They've given you a column that says absorption and a column that says variable. And notice how they list out the basic product cost, direct material, direct labor, overhead. And then they're trying to show you, in this case, the cost of goods sold aspect of each of these. Notice under absorption, you've got all of them. But notice how under variable, notice how you've got, see where it says fixed manufacturing overhead cost per unit? Okay, so under that one, variable cost is going to basically expense all of those fixed costs. In this case, it's $1 million. It's not going to put that as a cost of goods sold item. Okay, basically. So we'll get to some examples in a moment, but that's going to be a key. Is this $25 is going to be the key on how we reconcile the difference between the 2 types of income statements, which again, you may be confused at this point. Again, we're going to get you to some examples and show you exactly how we prepare them and how we reconcile them. But just remember that absorption costing is basically GAAP, variable costing is non-GAAP. So here's your traditional type of income statement. This is absorption costing. Notice the format: sales, cost of goods sold, gross profit, operating expenses, net income. Think of your cost of goods sold. I'm just going to write this. That's your product cost. That's all of your product costs are absorbed into cost of goods sold. And then all of your operating expenses, that's basically your period. Now, when we get to the variable costing income statement, we're not going to look at it like this, because we're just going to say what's variable, what's fixed. And you'll see how the format changes in a moment. Okay, so notice under variable costing, notice it says we assign only variable product costs to the products. Okay, so only the direct material, direct labor, and variable overhead. That fixed overhead is basically treated like a period cost. Okay, this is an internal income statement. I'm going to write this non-GAAP, means it's not audited. Okay. And eventually we're going to come up with this new thing called contribution margin. That's a big thing. We're going to be using that to look at break-even types of decisions in the upcoming chapters. Okay, so here's your variable costing contribution margin income statement. And again, just to remind you, this is variable costing. Notice the format: sales minus, this is all of, I'm going to circle these, all of your variable cost equals contribution margin. And then you subtract out all your fixed costs below that to get net income. So to simplify this, again, you take sales minus your variable cost equals your contribution margin. Then you subtract out your fixed cost, and then that's going to be your income, your net income, operating income. So notice under this type of income statement, you're looking at it from a cost behavior standpoint. Is a cost variable or is it fixed? It doesn't matter if it's product or period. So in this one, notice they've labeled this. We've got the variable cost of goods sold. We've got the variable operating. So that's kind of a mixture of both your product and normal period from the absorption. You just mix those in here because those are variable. And then under fixed, notice you've got fixed overhead, fixed operating. Notice this fixed overhead normally would be a product cost under absorption costing. But under the variable costing is they're expensing that just like a period cost. But you put it under this category of just what's your fixed and at the end of the day, you get your operating income. So this is a new concept, contribution margin. Know the definition. Again, contribution margin is when you take your sales, you subtract out all of your variable costs, you get contribution margin. Now, when you get to reconciling any differences between the two types of costing, it's also going to be whatever your inventory level is, okay, multiplied by, the key here is going to be that fixed overhead per unit will always be the difference in the incomes. Okay, so this slide gives you some of the key points about the variable costing and absorption costing. And again, remember, variable costing is non-GAAP, okay, it's not audited, okay. This is basically all about cost behavior, okay. It's all about cost behavior. Okay, so the basic, again, I've already talked about this, but your basic setup is going to be your sales minus your variable cost equals CM, which is your contribution margin. Subtract out your fixed cost to get net income. Okay, this contribution margin income statement will be used for all sorts of types of industries. We'll be looking at break-even analysis, targeted profit, stuff like that in the next coming chapters. But this is all internal. It's used only within the company. Again, I'm going to note this down here. It's never used for external financial reporting because it, again, is non-GAAP. And of course, you can read through all the different highlights. I'm just kind of talking. I don't like to just read bullet point for bullet point. But it is often thought that internally, the variable costing income statement is really, really useful for making decisions. Okay, so next up, we're going to look at a problem where we're actually doing both of these income statements. This is exercise S6-15. And this is O'Neill product makes a single product. We got cost, sales, and production information. Notice we've got selling price. They're giving us all of our product costs, variable manufacturing costs per unit. We've got direct material, direct labor, variable overhead is $35. Variable operating is $2. Fixed overhead for the year is $132. Fixed operating is $85. And manufacturing, this is what they produced and sold, is $12,000. Now, that $12,000, I'm going to circle that. You're going to need that because at some point in time, you're going to need to take these fixed overhead costs and you're going to divide that by the $12,000 because you always want to get a per unit manufacturing overhead for the fixed part of it. That's going to be your reconciling point when you reconcile these two income statements. All right, now we've got variable costing as the first one, absorption is the second, and the next slides we'll take a look at what these look like. Okay, so here's your variable costing income statement. I'm going to just kind of highlight the main categories here. Notice there's your variable cost right there. If you were to add these, notice you get contribution margin. And then here's all of your fixed cost, which in the previous problem. So selling price was 65. They sold 12,000 units. That's 780 in total revenue. The variable manufacturing costs were given. That $35 was given. You multiply that by 12, that's 420. Variable operating was 2 times 12,000 is 24. Total variable 444. You subtract that, you get contribution margin of 336. Your fixed overhead, which was 132, and operating fixed was 85. You add those, you're going to subtract those. You're going to get a net operating income of 119,000. Now, you'll notice that at some point in time, you may not in this problem, at some point in time, always keep this in mind that this manufacturing overhead that is fixed, you may need to divide that at some point in time by what they produced. In this case, produced and sold is the same thing. You'll divide that by the 12,000 to get a cost per unit because at some point in time, you may have to reconcile the two income statements. Now in this one, because there is no inventory, both incomes will be the same. So under absorption costing, notice your sales is the same. Your cost of goods sold now include, remember that's that fixed manufacturing overhead right there. Total cost of goods sold 552. Here's your gross profit. And then you've got your period cost of 85,000 plus your variable period of your operating, which was 24. So notice I'm going to make a note. These are your period cost. And then here's your product, just like we would have done in the previous chapters. Net income is only the same here because they produced and sold the same amounts. If they did have inventory, you would have to do a reconciliation, which I will show you that on some of the textbook illustrations on the other slides you'll see in Blackboard.